Today, I'm going to break down to you what the most important stocks you need to be paying attention to right now are. Well, I look at my accounts with Tesla just inching away from a 50% loss, and I'm going to give you a performance update very soon on the volatility of my dividend stock portfolio. But it's more important we look at these stocks coming up right now. So let's jump right into this. Welcome back, passive income investors alike. Today, I want to show you some stocks that I think you need to be paying attention to, and we're just going to whip right into this can of beans and insanities with Wynn Resorts, a stock I have never talked about in the past, but one that I think is super important at the current PE levels they're sitting at. Now, the reason there's been a lot of issues with Wynn Resorts in the past. The guy stepped down, the CEO of the company. If you don't know what Wynn Resorts are, everyone I ever talked to that's going to Vegas recently wants to stay at Wynn Resorts. It's either the Wynn or the Bellagio, but the Wynn always seems to be like the numero uno, the number one highest rated resort in Vegas. And I think they're trying to open up like a whole beach, like they're literally trying to build a little lake out behind the resort to basically be an even better resort. That beachfront to be like the only one in Vegas. It'd be really cool. But the stock's been under a lot of pressure, more pressure than I think it needs to be lately. And it's trading at a really low PE, considering, again, in my understanding, considering it's Wynn Resorts Limited. In my mind, it's more of a REIT. But it pays a really decent dividend. The dividend's been a little volatile, but as I've been recently talking about swing trading, I think this would be a beautiful company for a swing trade at these levels and a healthy dividend if you wanted to try and play this. Unfortunately, the problem with Wynn Resorts is when bad times come along, like credit cycles and things like that, as you can see, the stock doesn't do too well, considering in 2008, this company lost 87% of its value because people just aren't gambling. And this time that it dropped back up here, I can't remember the exact reasons. I think it was just the allegations and issues that had to do with Wynn himself leaving the company. And I don't know, there's a lot of weird stuff going on. I think this was around the time of the Vegas shooting, a lot of horrible things. It's just, I don't think it was a good timing for this company. But anyways, the company's kind of recovered, and now that they're hovering at the levels they are, I just think for the dividend they're offering, for their PE ratio, and what I know about the company, it is an incredible stock where it sits right now. And again, if we compare it to other kind of gambling stocks and resorts like MGM, it isn't even sitting close to the same dividend yield. And I mean, MGM is trading at a 51 multiple right now, a PE of 51, guys, and it never recovered from, and it lost a lot of value that it never recovered from the '08 crash. So if you're going to look into gambling stocks, guys, and I almost want to add this, it just reminds me of the drug stocks, which brings me into Constellation Brands. This company I haven't talked about in a while, but it needs some updates because the tariff war has been kicking this company a little bit in the backside as they deal with Modelo, one of the best-selling beers of all time, but they ship a lot of it to Mexico, the good old Mexico. The problem with that is they're getting tariffed. I can't remember what the rate is right now, but they're getting a good taxation on it thanks to Trump. So it's not helping my Constellation position here. I do own this one, actually. And I don't own Wynn, but I own this guy, and I can't get over this company. You did not know, Constellation Brands has been one of the best performing stocks lately in the last decade. Of pretty much, it's up there with some of the few best performing stocks ever. And right now it sits at a PE lower than almost every stock on the market, sitting at around 11, which is ridiculous for the growth this company has behind it. A dividend yield of 1.69. Now, the dividend yield, this is also a dividend growth company, because if we take a look at their dividends, guys, you can see that from 2015 when they introduced the dividend till today, they've almost they've over doubled the dividend. So if you bought it then, you'd be basically making double in less than about 4 or 5 years, guys. You'd be making double the percent here, and you would have had some incredible equity growth on top of that. I can't get over Constellation Brands. Like I said, it owns 50 or it's like 40% of whatever of Canopy Growth Corp, the largest marijuana company on the planet. The growth vectors in this company are absolutely absurd, and I think this should be on your radar, even with the taxation they have to pay due to the import and tariffs and all that BS. They're actually still able to sustain their current growth rates, in my opinion. It will hit them a little bit on earnings per share, but at the end of the day, this company's left lots of room to grow, lots of margin. They're going to be able to pay all their debts, no problem. And this is just a company that I think has a bright future ahead of it. And I am looking into buying more. I own a small position in it right now. If we go back to my portfolio, in my non-tax-free savings account, we can see that I own roughly 16 shares, or about $3,800 worth as of value today. A beautiful company. I will look into getting more shares of that soon as well. And now let's move into the banks. The things we're using that take all our commissions, that continue to show growth in their commissions and everything else that they seem to do, while they take your money and say, oh, hey, buddy, put your money in a 2% savings account. That's what you need to do. It's a smart thing. Don't invest it. Kind of risky unless you know what you're doing. You better invest it with us, because you don't know what you're doing. Meanwhile, we're going to take the money that you're having in your high interest savings account at 2%, and we're going to leverage it out on credit cards at 20%. Oh, the banks. I love the banks. Sorry, that's me being an over-exaggerated bank. But the banks right now are unreal. Bank of America, Goldman Sachs, all of these banks, where they're trading at, a lot of these companies haven't recovered from their '08 crash, even though they've increased their revenues well beyond what they were trading at '08. But honestly, I think Bank of America is the best U.S. bank at its current rating. It's one that I don't own. I used to own it, but man, oh man, I can't get past any of these banks. If we move into the Canadian banks, because the big short gentleman, the guy that shorted the U.S. banks, is shorting some of these Canadian banks, we've seen some pressure on these guys. Still trading a little bit higher multiple than the U.S. banks, but the dividend yields right now are so juicy, it's ridiculous. Bank of Nova Scotia, Canadian Imperial Bank, all paying over 5%. TD, BMO, RY, all paying over 4%. Beautiful starting yields, and something you guys should be paying attention to if you want to get into a good dividend yielding stocks. Banks are always a good place to start, guys, because if the banks go bust, the money in your pocket's just as worthless. And trust me, the last thing you're going to worry about is your stock portfolio if that happens. One that we've all talked about in the dividend community is 3M. It's been under pressure that we think is cyclical. It's just something that happens once in a while to this company. I don't know enough about this company's products to say you should be buying it. It's something you should look into, because 3M sells an incredibly large amount of products. But with what's going on in China, and I just don't know enough about this company's products, and I went over this company already, but I haven't done a deep enough dive, so I hope you have. PE is still kind of high in my opinion, for the capital that they've been losing. They've been laying people off and trying to rebuild up some cash income, but they've left so much room to pay this dividend. I think as a starting yield on a company like this for the products they do sell, I think if you just do a bit of a deeper dive, understand a little better, you're not going to go wrong buying 3M. It seems to be on a bit of a discount radar. Ding, ding, ding. That radar, guys, is going off for discounts. I'd be paying attention to this guy as well. And moving into some of the final things I want to look at is the drug stocks. I just talked about Constellation Brands, but you really got to be looking into these tobacco stocks. The current levels they're trading at, with the cash income they have, hasn't really changed as much as it's lost in value. The PE ratios are getting very reasonable for companies that are involved in marijuana, tobacco, and vaping. I think drug stocks are ever going to go anywhere, and I think at the levels they're trading at, even if you don't buy them, if you're morally against them, there's still stocks I really suggest you pay attention to, because it's a fascinating sector right now. It's evolving and changing, and these companies, if they can survive and withstand what is going on with the disruption, I think you're never going to go wrong, considering if we look at something like Altria Group, that if you got it a 6.5-7% yield 5 years ago, if you bought this company 5 years ago, around 2014, guys, you would have literally of almost, well, not quite yet doubled, but again, in 5 years, we've gone from 50 cents to 80 cents, which is staggering. It'd put you over a 10% yield, that's for sure. So if you bought this 5 years ago, you'd still be up on equity, and on top of that, you'd be getting a 10% dividend yield. So this is one that I have been buying the out of. I love this stock. I've been adding it as of last month. As I said, on my stocks that I purchased, I was definitely buying some of that MO, and along with British American Tobacco. I don't recommend buying these, but I would put them on your watch list and keep an eye out at these guys, because they are going to be doing some incredible things in my opinion. And I want to finish up with the last and most interesting one that I find the most confusing today, which is the REITs. The REITs. Some REITs have been taking a shittery kicking. Literally, some of them have been doing horribly. So we look at companies like Senior Housing Property Trust. This is one of those REITs that have just been getting kicked down lately with a really high yield. I did a wild deep dive on this, but a lot of dividend holders I know had this company for a while, and wow, they have not been doing that well. But the reason I find REITs so interesting is some of them have actually been doing better in these times, because usually When things get a little hairy in the markets, people want to go to where they would consider a safe, reliable, cash flowing. People chase dividends, right? That's why you see companies like McDonald's, Starbucks, companies that are just like non-cyclical things that you just know are going to do well no matter what. Companies like utilities right now that are they're just companies that will do well in rough times. And some of the REITs fall under that same alignment for dividends and why people will go after them. And there's ones like RioCan that I like a lot because in times like this, they seem to be doing pretty well considering real estate has been really rocky lately. But man, when you find the right people that know how to manage real estate and just give a reliable dividend that's not too greedy, considering we're sitting at a 5.5% paid monthly on this company, the PE is a little higher than I'd like. But if I were to I'd pay attention to the REITs right now, guys. It's weird that in times when, real estate's been getting iffy all around the world, in the US, Canada here, it's been getting rocky, leveling. There's been 20% movements up and down here. It's just incredible to see some real estate companies that are actually really thriving in this kind of volatile market because they have stable cash flow, and it's incredible how people will run to cash flow over pretty much anything else when times get a little bit rough. So I'd keep an eye out for that, and I hope you guys enjoyed some of my stock breakdowns today. I love breaking down some of these stocks for you guys, and these are the ones that have been on my watch list that I've been really paying attention to. And man, if I had some money right now, you just remember to slap a like, consider subscribing, guys. Let me know in the comment section below if there's anything that I missed that you would put on this list as well. So stay cool, stay awesome, guys. I look forward to chatting to you real soon.